If you want access to investment opportunities with potentially much greater upside than traditional investments alone, you have to be willing to think differently than the average investor. And I'm not talking about thinking recklessly or emotionally, and definitely not by chasing whatever coin happens to be popular this week. I'm talking about learning how to recognize change before it becomes obvious, learning how to study innovation while other people are still questioning it, and learning how to make an educated decision before the entire market agrees with you. Because if you need everyone else to agree with you before you feel comfortable taking action, you are probably never going to be early. That is something I personally had to learn. When I first entered crypto, I did not have complete certainty. I had questions, there were risks, and there was a lot I did not understand. But instead of asking, what is everyone else comfortable with? I started asking, where is the world going, and what evidence can I find before everyone else sees it? That shift in my mindset is what gave me the confidence to begin positioning earlier. So today, I want to walk you through 5 mindset shifts that I believe you need if you want to think like a future investor. These 5 shifts will help you recognize opportunities earlier, think more independently, and stop letting limiting beliefs make your investment decisions for you. And stay with me through the 5th one, because this is where most people get stuck. They want the upside of being early, but they also want the certainty of being late. And usually you cannot have both. And I know this because I've been in the crypto market for 7 years. I began positioning in several foundational digital assets back in 2019. And looking back at those charts today, it can seem obvious, but it did not feel obvious then. There was skepticism, there was uncertainty, and I still had a lot to learn. But I had researched enough to understand why certain assets deserved my attention. 3 years later, I co-founded Digital Asset Sisters with my sister because we wanted to help other people understand what it took us years to piece together. Since then, we've helped hundreds of people better understand this market through our early investor strategy, using research, proof, systems, and facts. And one of the biggest things I've learned is this: early investing is not only about finding the right asset. It starts with the mindset you have about change. So let's start with mindset shift number 1. Stop waiting for everyone else to agree. If you need everyone else to agree with an opportunity before you act, you probably are not going to be early. And there are actually numbers behind this. There is a well-known model called the diffusion of innovations. It studies how people adopt new ideas and technologies. Only about 2.5% of people are considered innovators. The other 13.5% are early adopters. Put those together and 16% of people adopt innovation early. Then 68% of people fall in the late majority. So 68% of people are not accessing the wealth from innovation. Think about what that means. Most people naturally want to wait. They want more proof. They want to see other people doing it. They want it to feel normal, and they want someone else to validate their decision first. Emotionally, that makes sense, but there is a trade-off. The more adoption you wait for, the more proof you require, and the more people you need to see participating, the less early you become. That does not mean being early is automatically better, but being early also means more uncertainty. But if your goal is to recognize major innovation before the majority does, you cannot expect to think exactly like the majority. This was something I had to learn back when I first started. If I had asked, what is everyone around me doing, I probably would have waited. Instead, I asked, what is the evidence telling me? What problem is being solved? Where is the technology going? What is actually being built? Who is beginning to use it? And do I understand enough of the risk to make an educated decision? I'm not telling you to blindly go against the crowd. I am saying, do not outsource your thinking to the crowd. Because if everyone else has to validate the opportunity before you act, you're waiting for it to become mainstream. So ask yourself, am I waiting because the evidence is weak? Or am I waiting because knowledge is weak? Or am I waiting because I want everyone else to go first? Those are very different reasons. If the evidence is weak, keep watching. If your knowledge is weak, you need to learn. But if you're simply waiting for everyone else, remember, the crowd gives you comfort, but being early gives you access to a different part of the opportunity. Your job is not to be first. Your job is to learn early enough to make your own decision before the crowd makes it for you. Mindset shift number 2 is this: stop confusing unfamiliar with bad. Someone hears about a new investment or technology and says, that sounds risky. And sometimes it is, but sometimes what they really mean is, I just don't understand it. Those are not the same thing. Think about online banking. 30 years ago, telling someone they would move thousands of dollars through a computer could have sounded crazy. Today, that same person may be transferring money while sitting on their couch. That is exactly what happened to me with parts of crypto. There were things I did not understand. Wallets, exchanges, blockchain, security, how assets moved. Instead of saying, this is confusing, so I'm staying away, I started saying, what exactly don't I understand? That made the problem so much smaller. I don't understand crypto feels overwhelming, but I don't understand how a wallet works is a question you can answer and learn. I don't know how to evaluate an asset is a question you can answer. And this is especially important if you've already been successful. Maybe you've built wealth through your business, real estate, stocks, or your career. You are used to operating in areas where you know the rules. Becoming a beginner again can feel uncomfortable, but future investors have to be willing to learn something new. So instead of saying, I don't understand this, so it must not be for me, ask, does this deserve my attention? Now mindset shift number 3. Stop thinking old versus new. Stocks are not bad. Real estate is not bad. Retirement accounts are not bad. Building a successful business is not bad. Those things have created enormous wealth. But being a future investor does not mean saying everything old is wrong. It means asking this question: what has worked for me and what is developing that may deserve a place beside it? And this matters because traditional finance itself is changing. The Bank of International Settlements, which works with central banks around the world, has described tokenization as the next step to the evolution of money and payments. So let me make tokenization simple. It is basically taking ownership of something and representing that ownership digitally so it can move through newer financial systems. And this is not just theory. In 2026, the DTCC, one of the major companies helping process security transactions in the US, used tokenized securities in real production trades. More than 30 participated, including BlackRock, JP Morgan, the NASDAQ, Goldman Sachs, the New York Stock Exchange, Vanguard, and others. And that does not mean every cryptocurrency benefits, and it definitely does not mean traditional finance disappears. What it tells us is the traditional finance companies themselves are building and testing newer digital infrastructure. So I do not look at this as an old versus new. Think about transportation. Airplanes did not make cars useless. Ride-sharing did not make personal vehicles disappear. And innovation gave us more options. Investing can work the same way. When I started researching digital assets, I was not thinking, I need to abandon everything else that I have. I was asking whether there was a different type of growth developing around the future of money, payments, and ownership. If you already have serious wealth, your goal should not be to tear down your foundation. Your goal should be to ask, is this something meaningful that I want exposure to? So here's your action step. Make 2 columns. On one side, write what is working, and on the other, write what am I missing? Keep what serves you, but identify the areas of innovation you have never seriously studied. Now, mindset shift number 4. Look for what could become necessary, not just what is popular. Average investors often look where attention already is. Future investors try to understand where new demand is developing. Imagine a completely new city is being built. Everyone is talking about one amazing restaurant. It's trendy, it's all over social media, it may become successful, but the city also needs roads, electricity, water, communication, payment system. Those things are really foundational. The city needs them to function. That is how I started looking at digital assets. Instead of asking, what is everybody talking about? I started asking, what could the future financial system actually need? I stopped focusing on only which coin was getting attention and started asking, what problem does it solve? Who needs it? Is anything really being built? Could real use create demand? Think about the early internet. The opportunity was not buy anything with a website. A lot of internet companies failed, but the internet still became foundational. Innovation can be real while individual investments fail. The same can be true in digital assets. That is why selectivity matters. So take any digital asset you own or are researching and ask these 4 questions. What problem does it solve? Who actually needs the solution? Why is this specific asset needed? And what proof exists beyond social media attention? If you cannot answer those 4 questions, it does not automatically mean the asset is bad, but it does mean you need more research before putting meaningful capital behind it. Demand matters more than hype. Now, mindset shift number 5. Accept that greater upside usually comes with greater uncertainty. People want upside with less uncertainty, and I completely understand why. But early opportunities usually do not work that way. If an investment has been proven for 50 years, if everyone understands it, if adoption is widespread, and if the market has already fully accepted it, there may still be a good opportunity, but the early part is gone, and the upside usually goes with it. Think about 2 houses. One is in a completely established neighborhood. The schools are great, the restaurants are there, everyone knows what the neighborhood is worth. The second is in an area where roads are being built, businesses are moving in, and development is beginning. There is more uncertainty. Maybe the area develops, maybe it doesn't. But if it does, there may be more upside because you entered before everything was proven. The second house is not automatically better. It simply has a different relationship between uncertainty and opportunity. Digital assets can work the same way or similar. When I positioned in certain assets in 2019, I did not have the amount of proof that exists today. That was the trade-off. There was unarguably more uncertainty, but I also had access to very different price points, very lower. Later, parts of my personal portfolio experienced exponential growth. That is my experience. It is not a promise to anyone else for these results, but the lesson was bigger than the return. You cannot demand the certainty of a mature investment while expecting the upside of an early investment. And if you already have wealth, I do not want you to hear that and think, I need to take bigger risks. That is not the point. The better question is, how can I keep my foundation strong while intentionally evaluating higher growth opportunities? You do not need to risk everything to gain exposure. So separate your capital and truly ask this question. What money is needed for my household, business, taxes, and near-term goals? That is essential capital. Then ask, what capital, if any, could I responsibly use to evaluate higher growth opportunities? That is opportunity capital. Do not mix the two. Greater upside does not mean you need to risk everything. So let's bring the 5 mindset shifts together. First, stop waiting for everyone else to agree. If you need consensus, you probably will not be early. Second, stop confusing unfamiliar with bad. Something you do not understand may deserve education before rejection. And third, stop thinking old versus new. Keep what works, but also learn what is developing. And fourth, look for what may become necessary, not just what's popular. Demand, utility, proof, they all matter. And fifth, understand that early opportunity usually comes with greater uncertainty. You cannot expect early stage upside with late stage certainty. But let me also make it clear, you do not need to risk everything to participate. You first need to educate yourself. Here's the question I want to leave you with. Am I thinking like someone who is simply protecting what worked in the past, or am I intelligently preparing for what may be coming next? Protecting wealth matters, but continuing to learn matters too. Recognizing change matters, and being willing to question your own limiting beliefs matter. If digital assets are an area you know you need to understand better, go ahead, use the link below to complete our digital asset self-evaluation quiz. It'll help you identify whether your biggest gap is understanding the opportunity, evaluating assets, building a strategy, or protecting what you own. Being a future investor does not mean chasing every new thing. It means being willing to learn before the crowd, think independently, and study where the world is going. And position intentionally enough so you can actually have access to this opportunity if your research proves right. Learn early, think independently, and position intentionally.